Hi everyone, this is the lecture on BOP and International Trade. Now, this is the last chapter of our macroeconomic syllabus, so make sure after the lecture you take a look at the tutorial to get yourself familiarized with this topic. Now, first, what is the balance of payments? What does it do? Now, the balance of payments or the BOP account is kept by every country to record their economic relationship with other countries. It consists of the current account, the capital account, and the last, the officials reserve transaction account. So it consists of these three main accounts. Now, each of them measures a different thing. We're going into detail to take a look. You can follow it through your notes, all right, to look at what these accounts measure. Now, how does the accounts in the balance of payments look like in accounting format? The current account consists of merchandise trade balance. Okay, we are talking about the in-out of actual tangible goods. Okay, depending on what the country needs to import and what the country is exporting. Okay, actual tangible goods moving in and out of the country. Okay, and services. Okay, follows next. Okay, so current accounts. The current account looks at goods and services that's being imported and exported by the country, okay, as well as net transfer. We'll take a look at what net transfer is later, okay. Now, the next account is a capital account, which records a capital inflow and outflow of a particular economy. And like how we calculate GDP, there's allowance for statistical discrepancy. Okay, something may be over or under stated in the last quarter or last accounting period will be adjusted in this period. Okay, so we have a allowance for statistical discrepancy. All right, and then there's an overall balance. The current account records international transactions of what is currently produced by the economy. Okay, so we're talking about goods, okay, actual tangible goods like we talked about earlier, and services. Now, the net payments are actually transfer payments. Now, we come across this term when we were studying GDP, right? Transfer payments. Now, in this case, these transfer payments are in the form of foreign aid payments to other countries or received from other countries, okay, depending on the situation of the country, obviously. Okay, so if the country receive foreign aid payments or give foreign aid payments, you come under this transfer payments category. All right, on top of the goods and services that's importing and exporting from the economy. The merchandise trade balance within the current account measures the import and export of tangible goods from the country or into the country. Okay, any merchandise goods like manufactured goods or like agricultural products. Now, if a country is selling more goods to overseas than buying from overseas, it will likely see a surplus. Okay, vice versa, if it's buying more from other countries than selling to other countries, then we will see a deficit. Now, take note, goods and services must be paid. All right, if we sell to other countries, they pay us. If we buy from other countries, we pay them. So when we see a merchandise trade balance surplus, what is going to happen is we will see that other countries are paying us more for our goods than what we are paying them for their goods. Okay, so merchandise trade balance, a surplus, would imply that the value of the goods that we are selling to overseas is higher than how much we are buying from overseas. All right. Similarly, the balance of services within the current account will record our import and export of services. So if you are selling a lot of services, in this case, we have some examples like shipping, insurance, banking services, financial services, or tourism. If we sell a lot of these services to other countries that we buy from them, okay, that means that other countries will have to pay us more than we pay them. Okay, so a surplus would mean, in this case, would mean that other countries pay us more for the services that we render them than we need to pay them. Okay. Okay, so the balance of services record the status, whether we are importing or exporting more in terms of services. Now, net transfer, we have talked about this earlier. Net transfers will record whether we are giving money to other countries, usually for charitable purposes, or we're receiving money from them because of charitable purposes. Okay, so if we donate money to other countries, it will be recorded as an outflow. If we receive donations from other countries, it will be recorded as an inflow. So net transfers will give us a status at the end of the accounting period, whether more money is flowing out for charitable purposes or more money coming in because of charitable purposes. Now, our capital account measures a different aspect of our economic activity with other countries. Capital account measures the inflow and outflow of funds for investment purposes, such as the buying and selling of shares, bonds, and treasury bills. Alright, so when Singaporeans go overseas to invest in other countries, it will be measured as an outflow. When foreigners come into Singapore, okay, to buy our shares, our bonds, our treasury bills, it will be recorded as an inflow. So the capital account will give us a status at the end of the accounting period to see whether inflow or outflow is higher. All right. Now, of course, we mentioned earlier that BOP, our balance of payments, also has an allowance for statistical discrepancy. Okay, so something over or understated last period will be adjusted in this accounting period. At the end of the day, the balance of payments will have an overall balance depending on what the situation is like in the current account, where it measures the import and export of goods and services, and what is going on in the capital account, which measures capital inflow and outflow. There'll be an overall balance. Okay. Now, if it's a positive, that means there's a surplus. If a negative, that means there's a deficit. Now, this overall balance must be resolved at the end of the accounting period. It cannot be left dangling. Now, when we see a balance of payment surplus, that means we're receiving more payments from other countries than we're paying them. All right. So these payments coming in could be paying for our goods and services that we have sold to them, or they could be pumping funds into the country for investment purposes in the capital account. Okay. So whichever the case, if we see a balance of payment surplus, that means there's a higher inflow than outflow. All right. This goes into the official reserves, or the government or the central bank may choose to repay loans to other foreign central banks. Okay. Usually it goes to the reserves. Or if there's a deficit, that means we need to pay more to other countries than we're receiving payments from them. Okay, maybe we have to pay to them more to them for the goods and services that we bought, or we are investing more in their country than they're investing in us. So whichever the case, there's a BOP deficit. Now, the BOP deficit has to be resolved, so we have to either pay the deficit from our reserve, or we have to borrow money to top up what is not enough. Okay, that means pay for the deficit. So the way that we handle a BOP deficit is quite similar to how we handle a fiscal deficit when we are looking at government accounts. Okay, it must be resolved. So if you bought more or you invest more in other countries, the deficit has to be resolved. All right, either you borrow from other countries or you pay off the deficit from the reserves. So how we handle the BOP overall balance is recorded in the balance of payments official reserve transaction account, the last account. This will record how we dealt with the overall balance. So if it's a deficit, all right, we may be paying off the deficit with our reserve or borrowing money, okay, to pay off the deficit, or if there's a surplus, it goes to our reserves. So the official reserve transaction account will record that. Okay, how are we handling the overall status, which could be a deficit or a surplus? Now, so far what we have talked about is the balance of payments, which is to record a country's economic activities with another country, such as trade and the movement of capital. Now, in this section, we want to think about this is why do countries want to trade with one another? Now, why do countries want to trade with one another? Now, in the 15th and 16th century, Europeans start to come to this part of the world, to Asia. All right. One of the reasons why they want to do that is to obtain goods that they don't produce on their own. For example, spices from Southeast Asia, which due to the climate and geographical terrain is only found in this part of the world. And they also wanted tea and porcelain, which they were not able to produce until the 19th and 20th century. All right. And another reason they wanted to trade was to sell goods that they could produce a lot. After the Industrial Revolution, whereby we saw the beginnings of the factory lines, whereby the production capability of European countries began to increase tremendously. They overproduced many things like cotton, and clothing, which they wanted to sell to other countries to exchange for things that they can't produce. Now, there's also an understanding that a single economy cannot produce everything or cannot produce all the quantities that are needed for their consumers. And there are gains to be reaped when they start to trade. So when we talk about trading between countries, international trade, we talk about the exchange of goods and services across national boundaries. All right. So there are certain benefits to trading instead of one country trying to produce everything on their own. Now, this kind of thinking stems from the belief in specialization. We believe that different economies have their own unique factors of production, their own unique resources, which makes them more efficient than other countries to produce certain goods. So every country has their own unique strength. So because they have their own unique strength, they can harness greater economies of scale when they produce these goods. One example I have here is corn production in the United States. United States alone produce about 42% of the world's corn production. Okay, because it has certain strength and uniqueness in their resources that makes it able to produce large amounts of corn. Therefore, if countries can specialize in producing the goods they're more efficient in, so they just focus on producing those goods that they got a certain advantage in, and then everybody come together and trade. Now, when they can do that, countries who trade. Now, to know whether a country has a certain advantage in producing a certain type of good, we have two theories to guide us. The first one is called the theory of absolute advantage. Now, what does the theory say? The theory says that if a country can produce a good with the least resources, that means either it produces more of the good with the same amount of resources, or it can produce the same amount of goods with the least resources, then this country is deemed to have absolute advantage in the production of that good. That means the country then should focus or specialize in producing that good. Now, in this slide, we have this example of two countries, England and Switzerland, and we have two products, cheese and watch. Now, these numbers are the output per labor hour. That means how much the Englishman can produce if they work for 1 hour. So per hour, the Englishman can produce either 8 units of cheese or 16 units of watches. Okay, the Swiss can produce 4 units of cheese and 20 units of watches per labor hour. All right. Now, it's not difficult to tell that each of these countries can produce more of one good given the same labor hour, right? So looking at this example, the Englishman can produce more cheese per labor hour than the Swiss. The Englishman can produce 8 units of cheese, and the Swiss can only produce 4 units of cheese per labor hour. But for watch, the Englishman can only produce 16 units of watches per labor hour, and the Swiss can produce 20 units of watches per labor hour. So each country has an absolute advantage in one of the product. England has an absolute advantage in the production of cheese, and Switzerland has an absolute advantage in the production of watches. Therefore, these two countries should focus and specialize in producing that good that they have an absolute advantage in, and then they should trade. All right, or export the goods that they're producing and buy the goods that they are not producing. Okay, so England should focus on producing cheese, right? Specialize in exporting cheese, and Switzerland should focus or specialize in producing watches and then export the watches. Now we have a second theory to see whether a country has a certain advantage in producing a certain good. Now previously we have studied the theory of absolute advantage, in which we use output numbers to measure whether a country has a certain advantage in producing the good. So if you can produce more of the same resources, or produce the same amount using less resources, you are deemed to have an absolute advantage in producing that good. Now in the theory of comparative advantage, we use another different indicator, which is opportunity cost. So the theory of comparative advantage says that if you have to give up less things to produce this good, that means you have the advantage in the production of this good. Okay, so the measurement becomes different. We use opportunity cost to measure whether a country has the advantage of producing this good or not. So if you have, based on the fact that you have less opportunity cost, then you should focus and specialize in the production of this good, and then you should export the good. Now we have this example in your course book. We have two countries, UK and Switzerland. Two products, cheese, watches. Now these numbers are given to us with 1 unit of resource. UK can produce either 40 units of cheese or 40 units of watches. Switzerland can produce either 8 units of cheese or 20 units of watches. Now going by the theory of absolute advantage, Switzerland will have nothing to specialize in, because both of the products, Switzerland actually produce less than UK. Okay, but given our theory of comparative advantage, each of these countries will have some goods, one of the goods to specialize in, okay, because the opportunity cost will be different. Now, we want to know for 1 unit of cheese or watch, how much is the opportunity cost for either of the countries. Okay, we want to know which country can produce each of the goods with lesser opportunity cost. Now to do that, we want to know what is the opportunity cost for 1 unit of cheese. Okay, now look at what the UK can produce, either 40 units of cheese or 40 units of watches with 1 unit of resource. So very clearly, the ratio is 40 to 40, which means that for every 1 unit of cheese, UK will give up 1 unit of watch. Okay, now for the Swiss, their ratio is either they produce 8 units of cheese or 20 units of watches. Now to find out how much the Swiss got to give up when they produce 1 unit of cheese, we need to divide this number by 8, and we must do so on the other side. So to find out the opportunity cost for 1 unit of cheese, we take 20 divided by 8, and the Swiss must give up 2.5 watches for every unit of cheese. Now, let's take a look at the other side. What's the opportunity cost for 1 unit of watch? Now, for the UK side, it's pretty straightforward because the ratio is 1:1. Either they produce 40 units of cheese or 40 units of watches. So it's 1:1. So it's very straightforward. Now, for the Swiss, they either can produce 8 units of cheese or 20 units of watch. Now, to find out 1 unit of watch, what's the opportunity cost on the other side? We divide 20 with 20, so we must do so on the other side. Alright, so we take 8 divided by 20 for 1 watch. The Swiss give up 0.4 units of cheese. Now, these are opportunity cost numbers. They are not output numbers, they're opportunity cost numbers. That means for 1 cheese, how many watch they're going to give up? For 1 watch, how much cheese do they have to give up? Alright, and it's not difficult to tell that for UK, they give up 1 watch for 1 cheese, which is much cheaper than the Swiss. The Swiss, when they produce cheese, they're going to give up 2.5 watches. So their opportunity cost is much higher. So UK has a comparative advantage in producing cheese. Now for watch, UK must give up 1 cheese to produce 1 unit of watch. But the Swiss only need to give up 0.4 units of cheese. So the Swiss has a comparative advantage in producing watches because they give up less cheese to do that. So their opportunity cost is lower. They have the comparative advantage in producing watches. So we pick the lower opportunity cost product for the different countries, and we can conclude by saying that because UK can produce cheese with lower opportunity costs, they should specialize in producing and export the cheese that they produce. For Switzerland, they should specialize in producing watches and then export the watches that they make. Alright, so they focus on the product where they can produce with lesser opportunity costs. Now, we mentioned that trade is beneficial to consumers because consumers end up with more of the goods and more choices to choose from. Now, at this level, you're not required to prove that consumers actually gain more of the good. If you're interested in that, you can pursue econs at a higher level and you'll learn how to calculate the gains from trade. Okay. Now, if consumers gain when countries trade with more of the goods and more choices, why is it that some countries choose to restrict trade? All right, this section we want to talk about that. Now, this behavior by governments to restrict trade is in fact protecting their own domestic industry. This kind of behavior is called protectionism. And we want to know why some countries choose to do that. Now, one of the reasons why a country may choose to restrict trade is the infant industry argument. Now, that means that the country thinks that this particular industry has the potential to compete and to make it big. But the problem is it has just only begun to develop, so, like an infant, not grown up yet. So protection is needed for this industry to realize its potential. So what the country does is it will restrict trade of that good in order to protect this so-called infant industry so that it can have the space and time to develop. Now, the second reason why a country may choose not to trade is the national security argument that the good involved in the trade is used to make certain defense equipment. So if you allow trade to go on, your own domestic industry that's producing that good may be put out of business, and that may jeopardize the security of the country. Now, one example of this kind of good is steel. Now, steel is used to make fighter planes, weapons, and most countries would like to have its own steel factory, even if they are not so efficient, because they don't want foreign control in the production of such an important product that is critical to national security. So when it comes to certain goods, some countries may choose not to trade on this national security argument. Now, the next reason for restricting trade is the anti-dumping argument. Now, a country may choose not to trade if it thinks that the exporting countries is selling their exports at below cost or at a price that's less than in their own countries. Now, that is deemed as unfair and you're trying to drive out competition in a very unfair way. So some countries may not choose to trade because they think that the exporting countries is competing unfairly by dumping their goods onto another country. Now, how do we evaluate these arguments for not trading? It is more efficient for the government, instead of restricting trade, to use subsidies to help their infant industry or to help their industry that makes important products like what we talk about steel to continue to operate. They can use subsidy to maintain these industries and not just restrict trade outright. Okay. Now, some dumping may not be undesirable. Okay, even though it's unfair, because consumers ultimately can buy the goods at a lower price. Okay. Now, if a country chooses to restrict trade, what are the measures it can use? In this section, we will go through tariff, which is a form of tax, quota, which is non-tariff, and the VER, voluntary export restraint, to restrict trade. Now let's first talk about a tariff, which is taxes imposed on the goods imported into the country. Now the way that it works is very similar to any taxes that's levied on to any good, just that now it's on an imported good, and the idea is to discourage consumers from buying these imported goods. Let's see how it works. Now let's take a look at the diagram showing a demand and supply curve. Remember your micro, demand and supply curve of this imported good. Now, at quantity Q1, the government finds that the level of imported good is too much. So the government wants to reduce the amount of imported goods in this country by using a tariff. Okay, so when the government imposes a tax or tariff on the importer, the supply of imported goods becomes lesser because it's now more expensive to bring in this imported goods. So supply curve shift to the left. Now when your supply curve shift to the left, you'll see that your new equilibrium point is now at B. Now at B, the new equilibrium point, the vertical distance between the new and the old supply curve will be the amount of the tariff per unit. This is the amount that's being taxed by the government now. Alright, now this causes the price of the product to rise from P1 to P2 and the equilibrium quantity in the market to fall from Q1 to Q2. Now take note, this area here, the shaded area, which is the tax per unit times the equilibrium quantity, becomes tax revenue to the government because it's a tax, right? So the government gains something from here. Now, to the consumers who used to buy this imported good, now they have to pay P2 instead of the P1. Okay, now so domestic production becomes more competitive because domestic prices did not change. So people may turn to buying domestic. So domestic production will rise. Now, this will lead to greater inefficiency because the economy used to be able to have this imported good at a higher quantity of Q1 and a lower price of P1. So now to have the imported good, consumers have to pay a higher price, P2, or if they can't afford the higher price, they may have to turn to buying domestic, which may not be something that they want in the first place. So this leads to greater inefficiency in the market for this good. Now let's take a look at quota. Now quota works in a different way from tariff. So quota is not a tax. Quota is a quantity restriction on the amount of goods that can come into the market. Now you have an original demand and supply curve, all right, with equilibrium price of P1 and Q1. Now the government finds this quantity Q1 too high, all right. There's too much of this imported good in the market, so the government will impose a quota which is less than Q1, so that there will not be so much imported good of this good in the market. So a quota is imposed at quantity Q. So the original supply curve no longer exists. What is happening now is the supply curve has become a vertical line at Q, because this is the amount of imported goods that the government is allowing to come into the market. All right. Now, if this is the new supply curve, take note of where the equilibrium point is now. The equilibrium point is now at B with a price of P2. So consumer now has to pay a higher price if they still want the imported good. Now let's take a look at the effects of a quota. Now the price of the good, as mentioned, has increased to P2 now, and the quantity has been reduced to Q by the quota. Now take note, the area here is now the importer's profit. Now the supplier of this imported good in a foreign country, all right, based on this supply curve, is selling to us at quantity Q, and the corresponding price is A. All right, but people are willing to pay for quantity Q based on a demand curve at price P2. So whichever company that's bringing in the good earns the difference between A, which is charged by the foreign company selling the good, and P2, which is what the local consumers wants to pay. So times the equilibrium quantity Q, this chunk, all right, this area here, now goes to the importer who bring in the good. It no longer goes to the government as in the tariff. Now this again leads to greater inefficiency, because consumer used to be able to obtain the good at Q1 and P1. Now they have to pay P2 for this same good. Now again, like what happened in the tariff, some of them may turn to domestic good, all right, which means that domestic production will rise. Okay, so those who still want the good will have to pay a price of P2. Now let's take a look at the difference in effects between tariff and quota. Now there's some similarities and there's some differences. The similar impact of a tariff and quota is that in both cases, the equilibrium price of the good, the imported good, goes up, and the quantity that comes in to the market is reduced. So the volume of trade has come down. But what is different is that for the tariff, because it's a tax, the tariff becomes a revenue to the government. Okay, but for the quota, all right, nothing, the government doesn't benefit from it, but the quota is able to restrict the product to a certain quantity. For tariff, all right, what it does is to raise the price of the good, discouraging people from buying it. The consumer can still buy the good, provided that they are willing to pay the higher price. But for the quota, once the quota is reached, the consumer will no longer be able to buy the good, regardless of what price they can pay, because the quota is reached. So the quota is more effective in limiting the amount of imported goods to a very specific quantity. Now the next way to restrict trade is called the voluntary export restraint. Now this way of restricting trade is very different from what we have discussed so far. We have talked about tariff and a quota. This voluntary export restraint is imposed by the exporting country. That means the country which is selling the product restrain themselves from selling to the importing country. So this is an agreement between two governments in which the exporting country government agrees to sell less to the importing country. We have an example here on the VER. In Japan, in the 1980s, they restrained the exports of cars into the US. The reason being, American car industry in the 1980s was in a very bad shape. So the Japanese car makers voluntarily restrained their exports into US. So they adopted a VER from 1981 all the way until 1994. So throughout these years, it's estimated that American car makers, because of a lack of Japanese competition, they made an average of additional $2 billion per year between 1986 and 1990, which is part of the period in which the VER was imposed. Consumer, on the other hand, lost about $13 billion worth in welfare losses because either they were made to buy American cars, which was not something that they wanted, or if they really wanted to buy Japanese car, they had to pay a higher price. So the consumers lost out big time. Now, when we review the measures in which the country can use to restrict trade, we can make a similar observation that it leads to greater inefficiency. The consumer either must pay a higher price for the imports, or they're forced to buy local, which may not be something that they want. So the consumers lose out. And when you impose a tariff or quota on the imported good, that country may impose the same on your good going to their country. So this can easily lead to a trade war that nobody wins. Now remember, when we talk about trade, it will benefit the consumers because they get more of the good through specialization, and they get a wider variety of choices. So when these kind of measures are taken to restrict trade, countries involved lose out on the potential gains from trade and specialization in the production of the good that they have advantage in producing. Now this is the end of the lecture for BOP and international trade. Make sure you take a look at the tutorial questions and review them. The exams are coming. You can go to Olive and take a look at past year papers and do some practice on your own. Good luck for your papers. Goodbye.